Hi there folks, now today I want to talk to you about what I think is the most popular technical indicator that's used by traders today. And that's the stochastic. Now the stochastic, pretty much like any technical indicator, I don't think should be used as a single standalone plug and play. Stochastics, indicators, they should be used in conjunction with other maybe technical analysis, be it support, resistance, price action, maybe other indicators as well. Unfortunately, life isn't as easy as just plugging in an indicator and it's going to make you a gazillionaire. Unfortunately, that is not going to work. But it's important that you understand all about this indicator and maybe you can incorporate it into your strategy development as well. So what I'm going to do now is just basically explain to you exactly what the stochastic is, what's it showing us, and I'm going to show you the three main ways that you can use the stochastics when determining entries and exits of a particular strategy. Once I've done this, I'm going to jump onto the screens and I'll show you real live charts as well, so hopefully things will become a little bit clearer as well. Before I forget, let me remind you, this week we do have another special treat for you. You can download the cheat sheet, which basically covers everything that I'm going to talk about in this presentation today. Basically talking about the three strategies, the three ways that you can use the stochastics indicators. So make sure you download that. So what are stochastics? Basically, stochastics are oscillators. Oscillators basically oscillate between two different extremes. You've got 100 and 0. Can't go higher than 100, can't go lower than a 0. Oscillators are typically leading indicators. They give us clues to where prices may go in the future, as opposed to a lagging indicator, which basically looks at previous price and tells you where it's been. So oscillators are leading indicators. And as I say, they range up and down between two extremes. Now, the way we use oscillators generally is we have levels where we consider to be overbought or oversold. And the overbought zone, normally with a stochastic, is anything above 80, above this line here, for example. All will become a lot clearer when we get onto the charts. And anything that's oversold will be a price action below the 20 line. So below 20 is oversold, above 80 is going to be considered to be overbought. Will become a lot clearer in a moment. Now the stochastic basically is formed with two lines. I don't want you to get too concerned about this now. I did see some other educators out there going into real depth about how they're calculated and so forth. I'm not going to go too deep into it, but I think it's important that you know exactly what the stochastic is. It basically is two lines. You've got a fast line, which basically tracks the recent close in relationship to the recent range. Okay, so it's looking at the recent close compared to where the last range has been over a predetermined amount. Default is, I think, 14 periods look back. So it's looking at the close relative to where the price has been over the last 14 periods. That's basically the fast. It's known as the percentage K line. Bit technical, I know. Don't get too bogged down by it. The fast K line is the relationship of the close to the recent range. Then you've got the slow line, which is simply a moving average. Default is a 3 period moving average of the percentage K line. If you understand moving averages, you'll understand that. If not, you can go and check that out. But basically, the slow line is a more smoother line than the actual K line itself. For the sake of this little lesson today, we're going to colour the fast line, the K line, with the blue, and the slow line will be red. Now, so I don't want to go too much into the details, but this is the formula that Lane came up with in the late 50s. So the fast line, the K line, is basically the closing price minus the low in the last 14 period, of that range, divided by the high minus the low over the same period. Don't worry too much about that. That's enough as I want to say about that. I'll show you on a chart in a moment exactly what it is showing you, and it'll make it a lot clearer. And obviously the percentage D line is the slow line, and that's the 3 period moving average of the percentage K line. So they're the formulas. If you want to take a screenshot of that, you can. You don't really need to know about that. But let me show you on a chart exactly what it is showing. Okay, so here is a simple bar chart, and you've got the stochastic indicator at the bottom of the screen. All indicators normally default to the bottom of the screen. I'll show you that when we get onto the charts in a moment. So you've got the K line, that is the stochastic line. That basically is represented in blue, and you've got the moving average of the K line in red. That's basically how it will look on the chart. Now look here, we've got a range of 14 bars here. 14 bars looking back, and the high in that 14 bar look back was around there, and the low was down there. But price, remember on a bar chart, the horizontal line to the right shows you where it closed. Basically prices closed pretty much at the top of that 14 bar range, and that is reflected there on the K line. So you see it's at an all-time high, or recent high I should say, of that 14 bar, then it rolls back. If you scroll further down the chart here, I've done another screen grab of a range here. So you've got a 14 bar range, there's 14 bars in this range, okay? And if you look here, price is basically in the middle of that range. And if you look at the stochastic indicator, signal there with that yellow little circle, is in the mid-range between 100 and 0. So the stochastic indicator is corresponding to the fact that the price is in the mid of the 14 bar look back, and that's why you'll see it there basically at around the 50 level. So that's basically what the stochastic is showing you. It's showing you the relationship to the close over the last 14 bar look back. 14 is the default that most platforms use, and I don't see any real reason why you'd want to change that. Okay, as I say, there are a number of ways that you can use the stochastic indicator. I'm going to touch on 3 here: the timing of when to enter and when to exit markets. And the first one I want to talk about is using the overbought and oversold areas for counter trend. As you know, when markets are trending, they don't trend forever. They do reverse at some point, sometimes break out into counter trend. Traders can use the stochastic to give them early clues that the trend is about to reverse or go, as I say, into counter. So basically, you can see here, when the K line, that's the blue line, crosses from an oversold area up through the oversold back, could indicate a trend change in direction. So it basically might market takes the price back through the 20 line here, and here we see a break higher, closing up through the 20, so moving from an area of oversold into the mid-range. That could indicate a buy turning point. Another one here, markets trend back down again, you can see, and the blue line, the K line, crosses down through the oversold, so now we're in oversold. You don't know how long it's going to stay in oversold, so we don't start taking buy trades at the moment, not until that blue line crosses back up through that 20 line. So when the market moves out of a oversold area, that's when you might consider a buy trade. Of course, I've cherry picked these. We're going to go onto the charts soon, and I'll show you what it looks like on a real chart. But I'll just show you here on the screen grab so it makes it a little bit clearer. Now, a sell trade will basically be when the K line, that's the blue line, that crosses down from an overbought zone. Okay, overbought, remember, is anything above 80. And when it's in that zone and then crosses back down through that 80 line, that could indicate a change in direction from an uptrend into a downtrend. So for example, here you'll see the blue line on the stochastic, it's moving up as price moves up. We go into the overbought zone, so we're crossing through this 80 zone. Okay, so we're in overbought. We don't know how long we'll be in overbought. We wait for the turning point for it to cross back through that 80 line, giving an indication that a sell signal reversal may be happening. And indeed, on the screen grab, that's exactly what happened, crossing back down through the 80, and market moves back down as well. And here's another example. Again, price moves down, then we start to move back up again. We go into the overbought zone, that's above the 80 line, and then it finally crosses back down through that line. That could indicate a trend reversal, and indeed that's exactly what happened as well. So any price that's moving from an overbought 80 zone back through could indicate a trend moving lower. So that's using overbought, oversold in counter trend. Okay, so now let's look at using the line crossover in ranging markets. As we know, markets are not always in trend. In fact, they are often in range for prolonged periods of time. A lot of traders use the stochastic indicator to help them predict the turning points within a range, not as a standalone. As I say, you've got to use this in conjunction with price action, other indicators. Don't think you can just plug this theory into an expert advisor, into your automated programs and give up your day job and retire. No, you need to do some other analysis on the markets as well. This is not just a plug and play strategy here. So how it works is this: it doesn't look at the oscillation levels, the 80 overbought or the 20 oversold. It's not concerned about that. It's looking at the line crossover. It's looking at the K line crossing through its signal line, basically the D line, the moving average of itself. And it works like this. So a buy trigger could be indicated when the K line crosses above, up through the D line. That could indicate a buy trade. And conversely, a sell trade could be indicated when the K line, the blue line, crosses down through its signal line, the D line, the red line. That could indicate a sell trade at the top of a range. Now, I've done a screen grab here. You can see the market is in range. Of course, this is hindsight. That's why I've basically done something that showed you something that works. But what I want to show you here is that how this did predict the turning points within this range. This stochastic indicator does correlate with the price action. It's just one big screen grab of the two together. I haven't just curve fitted this. When we jump onto the charts in a moment, I'll show it on a real chart and you'll see for yourself how effective it can be. But again, not to be used on its own. Right, let's have a quick look then. So here we see the blue line here now crossing up through the red line, indicating a buy trade as the market starts to move back up from the down move. And again, we see now the blue line crossing down through the red line, indicating a potential sell. So we're now still below, waiting for it to cross up through again. And indeed, it did happen there. A bit of a crisscrossing here. That might have cost you a little bit of money if you're trading this theory on its own. But that certainly did indicate a bit of an uptrend here, waiting for the blue line to cross down through the red line again. And sure enough, it happened. Blue crosses through the red, indicating a sell. And we saw this movement lower until the blue line crossed up through again, which was basically about there, indicating a buy trade. Okay, now we've got the blue line above the red line and we're still long until the blue line crosses through, and of course that indicates a down trade as well. So using these line crossovers to help predict turning points is very, very powerful, but again, not to be used just as a standalone indicator. And the last one I want to talk about, is the one I particularly like using, is basically using the stochastics to enter a trade within a trend. Now, I'm a trend follower intraday. I love to follow trends, but I always like to look at the higher time frame to determine the direction of the trend. So typically you might be looking at the 4-hour chart, the 240 minutes, and then you might be looking at the 60-minute chart, that's the lower time frame, and you may be looking for entries on the 15-minute time frame. So the 15-minute time frame is the chart that you're using to determine the entries and the exits, but you've got confirmation of the trend on the higher time frame. So as we know, markets are never trending in one direction without a pullback. Here you'll see the markets are trending down. We have a little bit of a pullback, as you'll see reflected there by the stochastics and the D line moving up. Okay, so when does that pullback stall? Well, using the stochastics in conjunction with other indicators, be it support and resistance or price action, can indicate, give you clues of when that pullback is going to stall. So here we go, the blue line crossing up through the 80 line, crossing back down now through, could indicate a sell trade. So that basically is telling us that this little pullback has now ran out of steam, and of course the market moves back down. Okay, and the same thing happens here. Markets are now pulling back down. In fact, they go into range here at the moment, but the stochastic is still showing higher highs as the last 14 candles. We see closing price at the top of that range, but then moves back down again, indicating that this little pullback has now ran out of steam, giving you clues that this may be a place where you can enter that trend again. Remember, the trend is determined by the higher time frame. And again, we're seeing the trend market trending down. Then we're having this little bit of a pullback, indicated there by the stochastics. We go above the overbought zone, waiting for it to cross back down through. Remember, the trend is down. It crosses back down through, indicating a sell trade there for the continuation of that trend. So I love the stochastics to fine-tune my entries in a trending market. I really think it is so strong when you see something like that aligning with other indicators, be it support and resistance or price action. So it's certainly something that I think you should explore. What I'll do now, I'll jump onto the screens and hopefully it will become a little bit clearer. Okay, so let's start off by showing you how to install the stochastics indicator onto a price chart. Now I'm using MT4, MT5 pretty similar. In fact, most trading platforms are pretty similar these days to this regard. The indicator will basically load at the bottom of a price chart. But this is MT4, so let's go. We go to the top here, see Insert, locate the folder that has the indicators in it. There it is, and scroll across and you'll see oscillators. Remember, stochastics is an oscillator. So find the oscillator folder, and there it is, the stochastics oscillator, just down there. Click on that, and that will load the panel where you can change the settings and so forth. We'll leave the default settings, 20 for oversold and 80 for overbought. We'll leave that there. You can go to the colors. You can change the colors should you wish to. I'm going to have my K line blue and the D line will be red. Parameters here, percentage K line defaults to 14. The D line 3 simple moving average. I don't see any reason why you'd necessarily want to change that. Click OK, and there will be the stochastics at the bottom of the chart. You can move that in the regular way. Okay, this is actually quite a good little example, really. You see a nice little uptrend here, and of course you've had a pullback into the 20, the oversold, and then back up through it again. Gave you a potential entry there. Here we see another pullback. In fact, this little pullback there is this pullback here, breaks through the 20 and then up through it again. Another reason to get into that trend. That's quite a good example, I'll just say. Right, what I'll do now though is jump onto the backtesting software. That way I can basically scroll through price and we can see the stochastics indicator change in real time as well. So it might be clearer for you to see. So we'll do that now. Okay, so here we are on the backtesting software. Now here I want to demonstrate to you the overbought and the oversold. At the moment you see the market is in an uptrend. We are in the overbought zone. So we are above the 80 zone at the moment. We don't just trade this because we're in the above. We want to see it break back down through the 80 to give us clues. And we want to use this in conjunction with price action potentially. So we'll just scroll on through. Now you see now we've broken through the 80, the overbought area. We've also broken through the signal line with this candle here. Quite like this one here because this one here does have some price action as well. Price action that we teach. You've got a bearish engulfer there at the top, and we're also seeing the stochastic taking us lower, which basically leads us to a nice trend to